Good afternoon, and thank you for joining us on today's webinar to discuss the current state of the MLP market and to provide our outlook for 2016. My name is Will Hershey of Yorkville Capital, and joining me today from Yorkville will be Darren Scheringa, Jim Hugg, Len Edelstein, and Mike Borges. If you have any questions during the course of the prepared presentation, please feel free to type them into the text box in the bottom right of your screen. We will hold a Q&A session at the end of the call, and we'll do our best to answer everyone's question. With that, I will turn the call over to Darren.
Thank you, Will. If 2015 felt like a bad year for you, it was. The thought that came to my mind was from an old song, "Oh, What a Year." Actually, that song actually had a good outcome, and 2015 certainly wasn't a good outcome for those of us who are invested in the MLP asset class. In fact, 2015 is the second worst year on record for MLPs. It was surpassed only by 2008, which was the Great Recession and the financial crisis. And if any of you are trying to understand the financial crisis still, I recommend seeing The Big Short. It's actually a great film that, in a humorous fashion at times, explains in layman's terms what's going on. We've coined 2015 the Great Energy Recession, and to a degree we see this as OPEC's swan song. And I'll touch on a number of milestones that we've seen in 2015 because we are witnessing history in the making right now, especially in the energy space. The milestones that we have seen is the virtual collapse of OPEC and its ability to set the price of oil. And part of that, well, all of these milestones have one common theme. The second is the U.S. and globally, we are producing more oil than we are consuming. So we have an oversupply situation of oil. The U.S. lifts a 40-year ban on oil exports, or lifted in 2015, and U.S. production levels reach highest levels in 43 years. So the common theme between these milestones and these historical events going on globally is the U.S. energy revolution. It is proving to be a very disruptive force globally. And the global energy markets are having to settle into a new normal. And the new normal isn't just lower energy prices. The new normal is that the U.S. has become an energy exporting nation. And we're heading towards the point where we will be the largest producer of natural gas and oil, surpassing both Russia and Saudi Arabia. So it puts us in a very powerful position from a geoeconomic perspective. So the question that we're going to address in the webinar today is really there's blood in the water. 2015 was a terrible year. In fact, in the first 2 weeks of December, it was the worst year on record, and MLPs rallied in the second half of the month. So there is certainly blood in the water. And the question that we want to address today is should we be fearful, or is there opportunity right now in the asset class? So the theme today will be fearful or opportunity. I'd like to direct you to the next slide, which is slide number 2. 2015 was the second worst year on record for MLPs, as I mentioned earlier. Now, there's good news and bad news to this. The good news is we've been here before, so we've learned a lot. The bad news is that we've been here before, that MLPs have had a pullback like this in their history. The graph in front of you shows 2 lines. The dark line is the current period, and what it's measuring is the price performance of MLPs from the peak to the trough. And the lighter line, or the gray line, measures the 2008 peak to trough of MLPs and then the recovery. And we measured the recovery to the number of months it took MLPs to get back to their previous highs. And as you can see, in 2008, it was they troughed in roughly a year from peak to trough, and it was less than a year before they recovered everything that they'd lost in this downturn. So, sharp downturn, a sharp recovery. We are looking at 2015 right now. Again, if you look at the lines, they're eerily similar. In fact, in terms of the duration and magnitude, the MLPs have dropped almost the same amount in both instances. Why did MLPs pop so much in 2008? Well, because fundamentals remained stable. 75% of all MLPs maintained or increased distributions. So as MLPs pulled back 50% from their peaks to the trough level, yields ballooned. Again, if you're maintaining your income and holding your income steady, but your price is declining, income divided by price equals yield. Your yield keeps increasing because it's not declining. So as we look at where we are today, we're not saying that, oh, based on this chart, 2016, we're going to have a pop in MLPs that will recoup losses in the next year. That's not what Yorkville is saying right now. But what we do want to look at are the similarities between 2008 and 2015 and in terms of fundamentals and current valuation. 2015, the next slide, second worst year on record for MLPs. I'm going to keep stating this because it was a very bad year and it was catastrophic. We don't want to downplay that from a price perspective, but there has been a huge disconnect. Fundamentals have remained very strong, and yet price has gone down. And we need to address and understand why that has happened. So part of that, the way we view the market, is that all MLPs have been treated the same to a large degree now. And what does that mean is that all MLPs have sold off in 2015, regardless of the fundamentals. And we see this in fear-driven markets. Again, you put a private equity or stable income producing asset like an MLP into a publicly traded wrapper, so it trades on public markets every day, it's going to pick up the sentiment of the market. And markets are driven at their most fundamental level by fear and greed over a short period of time, so extremely irrational. And like 08, we saw correlations of 1. And during the Great Recession, all risky assets came together and sort of performed the same. So what we've seen in 2015 is that all MLPs were down. All 10 sectors, which are the gray lines on the bottom of the graph you're looking at, were all in negative territory. The best performing sector, your downstream MLPs, was down 13%, and your worst performing sectors, your exploration and production companies, were down 67% on the year. The commonality, all were down, and so that's fear-driven markets, correlation, all negative performance. The green bar looks at the growth of distributions on an annual basis. So how much do distributions grow in every sector? There's two things I'd like to point out. Number one, there's only 2 sectors that had negative performance or negative distribution growth, and that was E&P. E&Ps cut their distributions by 60% almost, 58.8%. So E&Ps clearly, they are distressed, and their price performance reflects their fundamentals. And similarly, natural resources cut distributions by 1/4, and they dropped 42%. Again, 25% reduction in income in distributions is not healthy. A company that's cutting distributions clearly has some other issues that they're contending with. The other 8 sectors had positive distribution growth, yet all of them had negative performance. You can see the 2 fastest growing sectors last year were crude oil pipelines and general partners that both grew distributions around 18% exiting 2015. So the belief is that all MLPs have commodity exposure, and you can see that that is not true. The MLPs are different, and the fundamentals here show different growth rates, but the price performance shows all negative growth rates. E&P and natural resource companies clearly have commodity exposure, are clearly very different business models than the infrastructure business model, and we make a point of this all the time. When you are investing in master limited partnerships, it's more of a leasing business model, more similar to a real estate business model, which is you lease a floor out and a tenant pays X amount for this space for X number of years. And that's similar on a pipeline. Pipeline companies, MLP infrastructure companies, will lease pipeline capacity out to a tenant for X number of years. So really no different than leasing a floor. On the commodity-based business models, like an E&P or natural resource or any other energy company, the model is volume multiplied by price equals revenue. Well, volumes are coming down in the United States, so that's one bad thing for revenue. And the price of oil has dropped dramatically. That's another bad thing for revenue. So your revenues are coming down, your profitabilities are coming down, and ultimately distributions get cut. So very different business models. The infrastructure is a leasing business model. E&P or other energy companies have a very much more of a volume type times commodity business model. So the next slide here looks at infrastructure MLPs. The fundamentals remain strong. So again, this midstream pipeline storage, this leasing business model showed extreme stability, and the Yorkville Stability Score measures what percentage of companies or partnerships maintained or increased their distributions over a period of time, and this is looking at as we exited 2015, the fourth quarter. So a score of 10 means 100% of all partnerships maintained or increased their distribution. So the infrastructure MLPs, as measured by the Yorkville MLP Infrastructure Universe Index, 100% of all MLPs, infrastructure MLPs, maintained or increased their distribution, so no cuts. That's very healthy in terms of an entire asset class. Now, the Yorkville Growth Score of 11.1%, that measures how much on average did distributions grow in the most recent period. In this case, it's the most recent quarter. It was 11.1% growth. So distressed companies are not growing distributions. Distressed companies are cutting distribution, and on the previous slide we showed that E&P companies are distressed, natural resource companies are distressed, infrastructure companies, no distribution cuts, so that's an indication they're not distressed, and two very healthy growth rates of 11%. So again, back to our earlier question, opportunity or fear, clearly based on fundamentals, there is an opportunity here. Now, we are comparing, as we do every quarter, on this next slide, performance of the various asset classes. And if you look at the top right, REITs, S&P 500, and the 10-year Treasury all posted positive performance. Not a great year across the board, but at least you didn't lose any money. Up 2.8% for REITs and up 1.3% for 10-year Treasuries. And you look on the negative side, high-yield utilities, income-producing securities, alternative income-producing securities, were negative, significantly under both utilities and high yield were MLPs. MLPs, again, dropped almost 34% versus 5% drops for the other two asset classes I just mentioned. This underperformance of MLPs relative to the S&P 500 has only occurred a couple of times in history of the asset class, so it's a very uncommon occurrence. But again, we're not going to call because MLPs underperformed the S&P last year, they're going to outperform this year. I think that is faulty logic. It's more just a point. It hasn't happened that often in history. More, we want to stay focused on the fundamentals, so the fundamental support and point to an opportunity in MLPs based on where they are currently. This next slide here looks at asset class comparison. We looked at performance. Now we look at yields. The best indication of future price performance for master limited partnerships is yield, number one, and number two, it's the direction of yield, the growth of yield. So what we've seen here is a spiking in yield again. I mentioned that earlier. Prices come down. Distributions have been stable and growing 11%. Well, if your price comes down, divided by your income, your yield goes up. So what you see in the MLP universe is valuation is starting to support and become very favorable for MLPs at 8.5%. MLPs exited the end of last year. That's 4.5% higher than, so investors can get 4.5% more income per dollar from putting money with MLPs or investing in MLPs than they can investing in REITs or utilities. So it's much more efficient use of capital in terms of converting capital into income. And number two, it also, on a historical basis, you have not seen MLPs produce this much more income per dollar relative to REITs or utilities, except for very few occasions. So this is, again, a fundamental argument. Generally speaking, MLPs yield 2% higher than REITs or utilities. So at 4.5% at year end, that was almost 2.5 times or a little over 2 times greater income than they do historically, or spread-based income. So valuation supports a investment in MLPs currently, and later in the presentation I'm going to talk about January. There was another sell-off in the beginning of January which took valuation levels almost to as cheap as MLPs have ever been in their history. So at this point we're going to go into MLPs, why invest now, and look at the state of the asset class. And here we actually moved away from 2015 on some of these slides and started to look at what's going on in the first part of 2016 to bring you current. But starting with our first slide, this is a historical overview of what a leasing business model means and what an investment in U.S. energy infrastructure means when we talk about stable distributions or stable cash flow. The green line going up represents the distributions and the growth of distributions of MLPs from 2001 through the end of 2015, which is the modern day inception of the asset class, although MLPs date back to 1986. Basically from 2000 through current, the asset classes look the same. 80% of the market capitalization of MLPs, although it's grown a lot over the past 15 years, it's been 80% infrastructure. So the cash flows we're looking at again here are U.S. energy infrastructure MLPs. You can see steady growth. And as our two ovals point out here, fundamentals remained strong during the 08-09 financial crisis. You can see growth slowed but did not go negative. And again, during the 2014-2015 energy crisis, the fundamentals have even remained stronger. We've actually witnessed some growth in distributions, as I stated, 11% on a year-over-year basis. So my point, I'm sorry I'm going to make some of the same points again, but it's really important that these are not distressed assets. Infrastructure MLPs continue to grow distributions and have through financial crisis, and although we've had a dislocation now between price and fundamentals, that seemingly would spell opportunity. The second slide looks at something a little different, and why we created this slide was to, very busy, I'll try to make it simple, why we created this slide was to really explore the difference between a commodity business model, which is production multiplied by the price of commodity, in this case oil, equals your revenue. So if your production levels are coming down, which they are coming down in the United States, and we expect that production in the United States will drop 1 million barrels roughly this year from its peak last year at a little shy of 9.7 million barrels per day. So production levels are coming down, commodity prices are depressed. Of course your revenue is going to come down. Of course your profitability is going to be hurt. You may be bleeding, which means in the red you are losing money. If you're losing money, you need new money to come in order just to stay alive. So what you can see here is, in this case, the jagged line going through the chart is your price of oil. In 2008, it peaked at roughly $140. In 09, it dropped in the 30s, and the the gray line is your earnings for your normal energy companies, non-MLP, non-infrastructure. This is commodity-based production multiplied by commodity price. 12 months after the commodity price drops, look what happened with earnings in 2009. Earnings dropped dramatically for your commodity-based energy companies. MLPs in 08 into 09, the green bar continued to grow earnings in spite of the price of commodity. So fundamentals of MLPs are not tied to commodity prices. Fast forward, again, good news, bad news, we've been here before. Bad news, we've been here before. We've learned a lot from 2008 to 2014 into 2015. Oil dropped from 100 to 30, and you can see that, again, energy companies, a commodity-based business model, volume times price, earnings dropped dramatically from 14 to 15, roughly 12 months after the price of oil started to decline. MLPs, again, grew distributions on a year-over-year basis between 2014 and 2015. This slide, more than any, tangibly demonstrates there is not fundamentally, it is a different business model. We've been through two cases that show it now, two extreme, the great financial recession and now the great energy recession. In both cases, MLP earnings of infrastructure MLPs, different than commodity MLPs, have remained sound. So we get to valuations now. Current spreads are supportive of superior returns, and we're running these numbers through 12/31/15. The next two slides will be looking at the current low in 2016, which was struck last week. Spreads at year-end were 620 basis points above the 10-year Treasury. If you, again, look at this chart, the green bar is showing the spreads between MLPs and Treasuries. Most of the time, they're between 200 and 400 basis points. That's almost 70% of the time. 70% of the time that they are there, roughly 60% of the time that they're there. When you compare that with where they are currently at 620 basis points, which is on the right-hand side, just above that little box, it says 620 basis points. There's not often that MLPs trade at these valuation levels. And as a friend of mine once said to me early in my days on Wall Street was, right bought, half sold. Right? The price you pay for an asset more than anything determines the returns you're going to generate from that asset over time. So we're reaching valuation levels on MLP. We've already supported fundamentals. They're strong, but is the price right? Clearly, we've seldom traded at these levels, valuation levels. Now, we brought this slide up before, 620 basis points. Whenever MLPs have traded at spreads of this level or above, 100% of the time over the next 12 months, returns have been positive. And that's a little gold triangle, not triangle, but diamond that you're looking at, and those are the returns that you see. So as MLPs get cheaper, spreads get higher, you can see the returns get higher over the next 12 months. Really, the takeaway here, whenever MLPs have traded at these spreads, 100% of the time historically, they produce positive returns, and the returns on average have been what you can see in that little gold star above MLP. So significant returns. We're not forecasting those returns for this year. That's not the purpose of this call. The purpose of this call is just to analyze fundamentals and valuations, and is this a time to be fearful or opportunistic in the MLP asset class. So most of our data, all of our data to date through this presentation has been through 12/31. We're now going to look at through January 20th on the next page. One of the factors we were monitoring as a firm is absolute, on a relative basis, yield spreads are supporting an investment in MLPs. They're at historical high levels. The argument could always be made, well, 10-year treasuries are artificially low and should normalize. That's a whole other debate, and we're not going to enter into it today. But on an absolute basis, where are MLP yields? Because that's really true
valuation on the asset class. Where have they traded? What's the cheapest that they've traded on a historical basis? Well, it turns out it was in 2008, and intraday low on 11/21/08, which was the low of the asset class. MLP yields were 14%. The intraday low, which we had a catastrophic beginning to 2016, it was frightening how rapidly the MLP asset class dropped again, along with oil breaking through 30 into the high to mid-20s. At that point, MLP yields were at 12% relative to their all-time low of 14%. So imagine going from 8.5% to 12%. The spread valuations, how they changed as well, they went up by almost 4%. So we got into an area of MLPs that we've rarely seen before from a evaluation level, and that was on January. We analyzed that to look at what's our upside downside potential from these levels, and looking at historical distributions and applying two things: the highest yield based on distributions for last year, and we also looked ahead, but we showed growth, so we were more conservative by looking backwards. And then what's the upside to get to a normalized, to trade at a normalized yield rate, which is roughly 8%. So the downside was 17% downside to reach all-time high yields, all-time low valuations for MLPs on a yield basis. So it's not relative anymore. This is as cheap as you've ever been able to get into MLPs as an asset class. So downside 17%, the upside was 64%. And that's another way of looking at risk return across the asset class. So you have more and more factors lining up as prices continue to pull back early through mid-month, and fundamentals remain strong, and hopefully we'll get some questions on fundamentals later, and we'll address those in the Q&A. So price dislocation provides a good entry point. We saw a price dislocation with strong fundamentals in 08. MLPs were down 40%. They popped 80% in 09, recovering their losses, and as I showed on an earlier slide, in under 12 months. If you missed that initial pop in the market, because it's hard to time the bottom of any market, and we looked at what would your returns have been. Well, your returns then, if you were invested in 2010 through 2014, MLPs returned 18% per annum, and that's what that middle box says. So half right bought, half sold. The price you pay determines your returns. We believe, based on fundamentals, the energy revolution remaining in place, Moore's Life driving the cost of production down in the United States as our recovery rates go up from unconventional shale plays, that we are entering into an outsized period for MLPs potentially. Again, we don't know, we can't promise, but from, again, good news, bad news, we've been here before. What have we seen before? We've seen these type of returns. We don't know if it comes in 2016. We think 2016 will be a positive year based on fundamentals, but we do know over a longer period of time that you're moving into an environment where the last time Yorkville was here over a 5-year basis, we produced 25% per annum, 10% above the Alerian index over 5 years, and that's why we were recognized last year by Pension and Investments as the 4th best performing equity manager in the United States out of 1,740. So we think we're moving into a point, whether it's now or in a couple of months, but over the next 5-6 years, where MLPs really stand to produce outsized returns for investors. And that's why we left 2016 as a question mark. But for those of you who are curious, we do think 2016 will be an up year for MLPs as energy starts to stabilize and move higher, but don't expect it to get to $100 anytime soon. There is a new normal in energy pricing. So let's talk about the Yorkville MLP core income strategy. There's more to talk about now as a firm. We had some wonderful milestones in 2015 ourselves. In the latter part of the year, we received a mandate and were seeded by a large institutional investor to run a long-short hedge fund. That is something we are very proud of, something that we earned our position to do so just based on our understanding of the asset class. So there's more to talk about when we look at Yorkville right now. We're going to focus on the core income strategy because we actually use the core income strategy as the long portion of our what we call the Yorkville MLP Alpha Hedge Fund strategy. And so on the core income strategy, which is our flagship strategy, we're moving into, this year will be its 15th year of results. The results are GIPS compliant, so this is one of the oldest MLP strategies in existence. So fundamental alpha, that is our goal. We want to find two things for our investors. One is MLPs that have high-quality income, and we judge high-quality income by secure income, very low probability of cutting their distribution, and two, superior growth of income, because as Jim and Len have learned over 20-some-odd, pushing near 30 years here soon of investing in MLPs, that growth of distributions is the thesis that underpins why you want to be in MLPs. Otherwise, it would just be another fixed income investment, and it's not. So our stability score, the same way we calculate it for the entire index, we calculate it on all of our portfolios, is a score of 10. 100% of the names in our portfolio maintained and increased their distributions. We have, since 2008 through present, we have never had a distribution cut. So through the Great Recession, through now the financial, the Great Energy Recession, we've maintained distributions for our clients. It's just indicative of our discipline process, produces repeatable results across market cycles and across investment products. Our growth score, 22% as we exited 2015. That's roughly 2 times what the market's delivering. That's what you see in our portfolio. We are the growth managers of MLP investing, and that's where we drive the outside returns. There's a box we put out there. It's a great back-of-the-envelope calculation. Take your current income, add it to your distribution growth, and it gives you a good indication of what your total return potential over the next 12 months is for that security or partnership, and for you institutional investors without having any multiple expansion. So again, we delivered on our fundamental last year, no cuts in our portfolio, and distribution growth 2 times the market. Our current yield, the MLP Universe Index, we mentioned that year-end was yielding 8.5%. We're yielding slightly less at 6.7%. That's one of the things with higher quality, faster growing names. Our yield will generally be a little less than what the broader market is paying out. And that's a trade-off, again, between yield or growth. This is a total return investment strategy. Growth is going to stand you in better stead over time than income investing in MLPs. The next slide looks at our year-over-year distribution growth, and we again compare it to infrastructure at 11.1%, so 2 times the highest quality segment of the asset class, and relative to the MLP universe, which had some negative distribution cuts from the commodity side, which was up 3% on a year-over-year basis, and that's the number you'll see on the front page of our website as well. Significant fundamental alpha generated across our portfolio. The return potential, this is using the back-of-the-envelope calculation. Again, there's a few bars here. The gray bar is for the Yorkville MLP Universe Index. Again, it's yielding 8.5% growth at 2.9% or 3%. 8.5 plus 2.9, 11.4% total return potential. Our portfolio, 6.7% yield or current income, 21% distribution growth, total return potential, adding the two together of 28%. That's just a back-of-the-envelope calculation to quantify what I mentioned earlier. The performance on a historical basis, and remember I said good news, bad news. Good news is we've been here before. We've learned a lot from it. We understand it. We're not panicked. We're not happy about being here again. Bad news is we've been here before. Even having been here before, look at our numbers, so what it means to investors who have been with us since over the past 14, now moving into 15 years. On a one-year basis, all the stock picking in the world didn't help us produce better returns relative to what the market did. But if you look at a 5-year basis, 9.2% versus 1.5% for the Alerian index, so 800 basis points of performance over a market cycle, positive returns over 3 years. So even through the worst of a downturn, the overall returns are not catastrophic, although in 1 year they were catastrophic returns. So we've seen ourselves in the asset class get set up for a good recovery, and we see this as being an opportunistic time. So finally, in summary, really there's been a dislocation between price and fundamentals. We view this, we look at the markets as having a compelling risk and return profile, and I leave you with this question: if not now, when? I'll turn it back over to Will.
Thanks, Darren. Appreciate the informative presentation there. With that, we'll jump right into Q&A. We already have some questions in the queue. Just to remind those of you who may be joined a little bit later on in the call, feel free to type any questions you have in the bottom right corner of your screen in the Q&A box. If we don't address your question on the call, we'll be sure to reach out afterwards. So with that, we'll get started. Mike, if you don't mind taking a stab here.
Sure.
What happened with Kinder Morgan and that whole story, and kind of how does that relate to what's going on with MLPs overall?
Sure, Will. First off, let me start out by saying the Kinder Morgan situation was unique, and it doesn't broadly apply to the MLP asset class as a whole. Really, Kinder's situation can be boiled down to one thing, and that's leverage. Kinder had over $40 billion of debt on its balance sheet, and early in December, it acquired a company called Natural Gas Pipeline Company of America, and this acquisition led rating agency Moody's to put KMI on negative outlook. And Moody's said that due to the high leverage, KMI was at risk of losing its investment grade rating. Now, as I mentioned, KMI had over $40 billion of debt, so a downgrade from investment grade rating to junk status would have had a significant financial impact because their cost of debt would have gone up significantly. In 2016, KMI was still expecting to grow its distributable cash flow 6 to 10% to $5 billion. So really, KMI had a dilemma of what to do with that $5 billion, how to allocate it. At the time, KMI also had a project backlog of greater than $20 billion because they've identified enough projects due to the still very strong demand for U.S. energy infrastructure projects in development. So what KMI decided to do is that they thought it was most prudent, given the financial impact of what would happen if they went from investment grade down to junk status, to protect their investment grade rating. So they decided to cut their distribution, to allocate that capital to fund their growth CapEx, and obviously reduce their debt load. They essentially chose to grow rather than to continue paying out their distribution at such a high level. Now, as I mentioned, it's unique, and that situation doesn't apply broadly to the MLP asset class. Now, Will, to answer the second part of that question, what we're starting to see from other MLPs going into earnings season as they provide guidance for 2016, really the partnerships that are clearly able to identify the roadmap for the year, meaning what is their CapEx spend going to be, how are they going to be able to finance it, what is their liquidity position, and how are they going to maintain their distribution. Companies that provide transparency into this blueprint and really roadmap for 2016 and beyond will be the companies that do better in the near term, given all the uncertainty around these broader questions.
Thanks, Mike. I think it's great points you brought up, and I think a lot of people are painting the entire energy infrastructure asset class, and even though Kinder's not an MLP, taking what they saw with Kinder and trying to paint everything with a broad brush, everyone's in the same position. No, a lot of liquidity concerns are unique to a given company. A lot of basin concerns are unique to a given company. So it's a very important question to address there. A lot of the questions that have come in have really been higher level. Are distributions safe for 2016? And if so, how can you get comfortable with that thought? So I guess, Jim, if you don't mind addressing that at a high level.
Sure, Will. I think it's important to look at what happened in the past. In the past, the focus was on growth and current income. And with MLPs selling at high multiples or more accurately low yields, it was easy to tap the equity markets, and with interest rates low, and they still are low, it was easy to issue debt. So this resulted in a very low cost of capital for the MLPs, which was a wonderful thing for MLPs, and it was a wonderful thing for investors. But as Darren pointed out, last year in 2015, with the price of oil coming down and impacting, of course, the upstream, but even the midstream, the MLPs came down, and this has had a detrimental effect on their ability to raise capital. So there are now really two, the way we look at it, there are really two major themes. And the first theme is, and that is one that it's always been important to MLPs, is to maintain distributions and increase them. The second theme that people are really looking at now is to the balance sheets and what are MLPs doing to strengthen their balance sheets. And this is because investors and the ratings agencies are really focusing on how strong balance sheets are. So some of the things that the MLPs are doing are they're selling assets. Some, such as what Mike talked about with Kinder Morgan Inc., they have issued preferred stock. They've entered into joint ventures. They've issued hybrid securities. And also, an important thing that they're doing is that they are keeping their distributions, and they don't want to cut them, but they might not be increasing them, or if they're increasing them, they're only increasing them, just a modest amount. And finally, they're cutting back, many MLPs are cutting back on their growth CapEx. And we've seen that just with a couple of names with WPZ and KMI. I know KMI is not an MLP, but so if an MLP has a choice of a number of projects, and one is yielding or they're paying 9 times EBITDA, and another one is 7 times EBITDA, they're going to probably put on the back burner, just eliminate the one that they're having to pay a higher price for. So I think what's to kind of conclude this, I think what you're going to see is kind of a Darwinian situation where the strong are going to survive, and you're going to be really, as Darren pointed out, you're going to be richly rewarded in sticking with the high-grade, high-quality MLPs. So again, we continue to be positive on this asset class, but you have to be particularly careful now.
Great, thank you, Jim. And I think that segues well, kind of along the same lines, Darren, if you don't mind taking a stab here. With the capital markets not completely shut off, we've seen some deals out of some of the lower yielding, higher quality names even over the last quarter. But with the capital markets more or less kind of shut off to MLPs, as well as the potential for volume declines in the U.S. coming online, do we see some distribution cuts from MLPs? How do we get comfortable overall with the asset class?
Okay. So a lot of the focus of investors that we've been speaking to recently, and especially our friends in North Dakota, have been focused around production declines. And clearly, production declines are hurting exploration and production companies, and will continue to hurt exploration and production companies. And so we see that E&P companies, whether they're formed as a partnership, so as a master limited partnership, or whether they're formed as a C corporation, are going to be under pressure, and we will see more bankruptcies. So there will be more bankruptcies in the commodity-based business model and commodity-based businesses because of low oil prices, and because we are going to see 1 million barrels less production coming out of the U.S. this year. So that is absolutely factual. And we're not running from that. What investors aren't focusing on is that demand in the United States is alive and well. So there's a number of anecdotal evidences. There are fewer searches on Google for Teslas, more for pickups and four-wheel drive. So that is clearly follow the money. Look at what cheap energy and the behavior that is now starting to direct. So consumers are paying under $2 a gallon again at the pumps. And that is freeing up a lot of cash flow to do other things, and one of them are driving more miles driven at record levels. So all of the above is starting to change behavior. Consumption is doing well. Well, we've positioned our portfolio, and let's speak to that, because clearly if you like MLPs, we think you should, and if you like them now, which we think is a great opportunity, whether we're at the absolute bottom or very close, we think we're very close, then we want you to invest with Yorkville, because we believe we can do as good, if not a better job than anyone in navigating the space successfully. So what we've done over time is 100% of our portfolio is infrastructure-based. 100% of our portfolio is looking towards it's infrastructure fee-based. Right now, we don't have any commodity exposure. We don't have any spot exposure. We don't have any volumetric periods. Are very nominal. Our distributions are protected by contracts across our book. And finally, we're playing more into the demand side. We want to be. We have pipelines that are agnostic to whether supply comes from North Dakota or Saudi Arabia. That our pipelines are going to be full because demand at the refiners or at the utilities still needs to be met with oil, with natural gas, and distilled product that is being produced still needs to get delivered to ultimately the gas stations, and that makes it into your fuel tank. So that aspect of the asset class is booming, record miles driven. Yeah, it's really healthy, and a lot of investors aren't focusing on that side of the equation. It's all part of the supply. So there is a dislocation here. You need to be careful. Not all MLPs are treated the same. But as it relates to those MLPs that are growing distribution strong, balance sheets, good coverage ratios, they have access to the capital markets, and we've seen deals getting done. In the fourth quarter of last year, straight equity deals are being done. You still have MLPs that are yielding 5% and lower, and you have MLPs that aren't going to cut distributions that are yielding 20%. So there's a lot of opportunity. There's a lot of stock picking that can be done in this market. We believe, based on our fundamental analysis, we have the opportunity to make a lot of money here.
No, that's a great point. I think you kind of had a secular bull market in MLPs that really bolstered a lot of names that maybe weren't deserving of such valuations from 2010 through 14. Now everything's fallen off in the same kind of, correlations to one kind of way. Now there's opportunity to pick amongst winners and losers. And
that brings up one other point, is that if this bull market in MLPs drove them higher, that and not all MLPs are created the same. The credit rating agencies, when they look at the leverage that MLPs are allowed to take, they use the same metrics that they use for utilities. Now, speak about a stable cash flow generating business, it doesn't get much better than a utility. So the credit rating agencies view infrastructure MLPs along the same lines that they're viewing, or use the same metrics, not along the same, they use the same identical metrics in leverage for MLPs. So the credit rating agencies, they're not going to change that. We sat in on a number of panels, we've spoken with credit rating agencies. That's not going to change anytime soon. So this is a very stable cash generating business, similar to even utilities from a credit rating perspective.
No, that says a lot that the rating agencies are looking at it the same way.
And one distinct advantage that MLPs have versus utilities is they don't pay corporate taxes, which significantly lowers their cost of capital.
Absolutely, great point. Along the same line, everyone kind of really wants to focus in on distributions. Mike, maybe you could take a stab here. How do distribution coverage ratios look across the asset class today, and kind of where we stand versus historically?
Sure. So I think that's a great question coming in, and it's one thing we actually looked at in our most recent Yorkville MLPB. When you look at median coverage ratios across the entire asset class, when you look for infrastructure MLPs, you can see the median coverage level is about 1.1 times. So It shows that they have roughly call it a 10% buffer between the distributable cash flow that they're generating and the distributions that they're paying out. Now, to some of the earlier points that both Darren and Jim have made is that not all MLPs are created equal. So one thing to consider when looking at adding new investments is to analyze the company's coverage ratio. Obviously, partnerships that have coverage well above 1 times illustrate that their earnings are more stable and they provided more of a cushion to weather any sort of volumetric or earnings volatility that could persist in a lower for longer environment.
Right, and it will be interesting to see with that coverage above 1 whether some MLPs decide to hold back on growth that they're not getting rewarded for right now, and maybe continue to bolster that coverage as we kind of weather the storm here. With that in mind, weathering the storm, if oil stays lower for longer, and I'll leave this to the group, if oil stays lower for longer and the capital markets remain somewhat weak, which sectors within the MLP space seem to be the most defensive or able to withstand a sub-$50, call it, price threshold in oil?
Yeah, sure. So certainly you want to look for partnerships within the infrastructure segment. Obviously, these companies have a lot less commodity exposure. They're your more traditional pipeline and storage companies. And I think when you look at that, go into your more traditional midstream assets, so companies that operate pipelines and storage units, really what you want to look for is assets that are demand pull rather than supply push. What I mean by that is that when you have pipeline companies that are distributing oil from refiners to end users, whether it be utilities, for example, you can count on that demand being fairly stable. When you have gathering or processing assets that are closer to the wellhead, you're much more exposed to volumetric risk. And if a certain producer in that basin runs into financial hardships, those volumes that a MLP are used to getting are more at risk of being cut off, and then you could see earnings volatility in that particular partnership.
Great. And I think kind of on a similar line of thought, while I'm paraphrasing the question here, and we're by no means legal counsel, but let's give it a shot. What happens and how do we think about a counterparty, whether it's an E&P company, which is most likely those to potentially have that occur, is to go bankrupt? Without getting too specific, what happens to the contracts on a high level, without too much detail?
A lot of the conversations, conferences, calls that we have been having recently have been around this, and just to understand more of what is our exposure to counterparties, because clearly in a leasing model you are into a long-term contract with a counterparty, and if the counterparty is unable to pay and meet its commitment to you, well, that's a very bad situation to be in, right? That will clearly negatively impact revenues. It would shut them right off if they stop paying. So what we have discovered, and this is at a high level, again, legal advice, tax advice, we're not going to go there, but a couple of things. One is the standard seems to be that we have taken from these conversations and conferences that we've attended is the contract at fair market rates. Generally speaking, if it's a FERC contract, it's federally regulated, so that's going to be at a fair market rate. So those contracts are not under question. The contracts now that are not federally regulated, are they fair market? Well, generally speaking, they are fair market because you're dealing with two sophisticated buyers, so no one is abusing anyone else. And generally speaking, again, that these buyers or the parties entering into a contract have entered into multiple contracts to know what a fair market rate is. Then what we find is so historically we haven't seen a lot of contracts be reset. We haven't seen any adverse contract renegotiations done in 2015. Historically, we have not seen a lot of contracts get reset, and why? Because ultimately, the bondholders, this idea, and this applies more to gathering and processing, where you're going to be front-facing, or the E&P companies, is that what's in the best interest of the bondholder. So if the contract's at a fair value and you have one gathering system and no other way of getting your product to market, well, you really have one choice if you want cash flow to continue going and generating any revenue, which is good for the bondholders. You need to keep moving your molecules from the wellhead to the end user. So generally speaking, the contracts are honored at the rates that they were established beforehand. It's in the best interest of the bondholders to keep the revenue flowing. So we don't see it, although clearly counterparty risk is a major risk. Given this unique nature of MLPs, again, one pipeline, lack of competition, which we love when we're looking for investments too. We don't want we want inelasticity of supply too. We want one choice. Ours is the only roadway going out of the valley. If you want to get out of the valley, you need to take our roadway and you're going to pay our toll. That's a beautiful protection of investing and forecasting where future cash flows are going to come from. Unlike in consumer electronics, if I have an Apple iPhone and I decide Motorola's coming out with something that's 10 times better, well, I could sell my Apple and buy a Motorola overnight. With pipelines, it doesn't work that way. So we understand the risk. We're keenly aware of it. We look at counterparty risk. We look at customer concentrations, but we don't see it as being a big issue. And there are more bankruptcies coming out. And it's also why we've moved our portfolio away from anything closer to the wellhead, because we want to be secure and not have our first distribution cut in our 15th year.
I'll let the Motorola analogy slide. I don't know if it's fresh in the current moment, but the question here, Jim, I feel like we always are addressing this, but do you see any potential with the current political candidates in play about looking at addressing the tax treatment for MLPs, potentially taking that away? Have you heard any rumblings of that coming up?
No, I've not heard any rumblings about it, and I think with the candidates that are running both in on the Democratic side and the Republican side, I have not heard anything along those lines that they're going to go after MLPs. And bear in mind that the one bright spot in the economy in the last few years has been in the energy section. And I don't think that whether it's Bernie Sanders or Hillary Clinton or Trump or Cruz or Rubio or any of the others are going to do anything that I think would be disruptive and penalize the oil and gas industry. So I am particularly to answer your question, MLPs.
Yeah, and I think probably at this point the amount of revenue that would be gained as a result of changing it would be a de minimis there. We're almost nearing up on 3 o'clock here, at which time we'll have to reach out individually to answer your questions. But coming back to kind of a higher level, what would you say to someone who says that the MLP model has been broken and where things are now with the capital markets being the way they are? How would you address that concern? I know we've kind of touched on it in different ways, but a little bit more just directly on that.
Mike, you want to take a crack at that from the last MLPB? That was sort of what we're trying to examine, just is the MLP model broken?
Sure. So as I was mentioning the Kinder situation earlier, Kinder's problem, as I mentioned, was primarily due to leverage, but also it was the fact that they were not able to access the capital market to continue to fund their growth CapEx. Their leverage, as I told you, was high. It was bordering close to 6 times total debt to EBITDA, which was above investment grade parameters, and also their yield was north of 10%. So also to do any equity issuances at that levels would have been dilutive. So their cost of capital was just way too high. Now, as I was mentioning, when we looked at the last Yorkville MLPB, we looked at infrastructure companies, infrastructure partnerships, access to capital markets. The median leverage ratio for infrastructure companies was below 5 times. I think it was 4.9 times. So it shows that, broadly speaking, MLPs still have access to the debt markets. And also, when you look at the median yield, it's still below 10%. there has still been a number of MLPs that have issued equity over the past couple of months. And I think that really goes to some of Darren and Will's earlier points that not all MLPs are created equal. So you see partnerships out there that have good business models, strong assets, strong supportive sponsors, assets in attractive basins. They're able to access the capital markets due to the fact that their fundamentals do remain strong. Dan, did you want to add something?
Sure. And I think we'll wrap up on this, and then we'll be happy to call us directly, please, at 212-755-1970, or send us an email, text something on the webinar, and we'll follow up with you. My concluding comments to is the business model broken? I think Jim hit on it earlier. The cost of capital advantage doesn't disappear. So think of it. Your federal tax rate is 35% in the United States currently. So if my distributable cash flow is going to, if I'm going to have to take a 35% haircut on that same cash flow, what is the value of my cash flow relative to someone else's? It's 35% greater. I mean, it's the difference between getting $10 or $6.50 of cash flow from the same asset. It is a tremendous capital advantage that these companies have. So that is not going anywhere. I think the question is really, if the capital markets stay closed off to MLPs, what will happen? What will happen is infrastructure still needs to be built. This cost of capital advantage won't disappear. Alternative sources of funding will come in. So there will be other private equity money that will come into the market. There'll be other institutional investors that are going to come in and be willing to do deals outside of the public market. So what will happen is the deal flow will move around the public markets. And that's why we're seeing preferred issuance come out at 8% when companies' yields are trading in the mid-teen levels. Institutional investors understand the business model. Right now the markets aren't. So there are going to be disruptions in the marketplace. But this cost of capital advantage doesn't go away. Our need for infrastructure isn't going away. And oil at $30 and $27, it doesn't work for anyone. It doesn't work for Saudi Arabia. It doesn't work for U.S. producers. It doesn't work. Long term, these are not sustainable oil prices. Having said that, oil isn't going back to $250 anytime soon, so that's gone. It's not going back to 100, we don't believe, unless it overshoots. It will be driven by the cost of incremental supply. And the cost of incremental supply is going to be driven by the U.S. Right, and that's a whole other conversation we'll have it another day. But in conclusion, and I'll turn it back to Will, we see this, and it's not because we're only MLP investors, and for our clients who have been with us through the energy crisis, thank you. It's been painful. Thank you for your trust and the faith that you've placed in us. For new investors, we welcome you. We see this as a wonderful opportunity, both based on fundamentals that are in place. We're able to find, there's growth across the asset class, so we're able to find better quality names in our portfolio, and the dislocation between price and fundamentals, and now that even on an absolute basis, MLPs almost touched record levels of high. That shows you how bad the situation was, because all of us who lived through 08 remember how bad 08 was, and we've just lived through an 08 in energy. So we see this as a wonderful opportunity to get in an established position if you're not in, and if you've already been with us, you know, sorry for the pain, but this too shall pass. So Will.
Great, thank you, Darren. I think that's a great way for us to leave off here. Thank you once again for joining us on today's call. As a reminder, we will have a replay of the webinar up in the coming days on our website at yorkvillecapital.com. And please feel free to email us at info@yorkvillecapital.com, as Darren mentioned, or give us a ring at 212-755-1970. We are available to talk further. So thanks so much, and take care.